I am Jayachitra, Assistant Professor of Commerce Computer Application from SA College of Arts and Science. I am going to explain about capital gains. Section 45 to Section 55 of the Income Tax Act 1961 deals with the income from capital gain. Profit or gains arising on transfer of a capital asset shall be chargeable under the head capital gains. Basis of charge under section 45. Capital gain arising from transfer of capital asset shall be taxable in the previous year in which the asset is transferred. It is deemed to be income of the year in which such transfer takes place. First we will see the meaning of capital assets. What is capital asset? Capital assets mean any kind of property held by an assessee. It may or may not be relevant to his business or profession. For example, the goodwill, the leasehold rights, share of partner in partnership, license from government to manufacturing goods, etc. are considered as capital assets. It may be movable or immovable, fixed or circulating, tangible or intangible. Next, we will see the types of capital assets. Capital assets can be classified into two types, namely short-term capital asset and long-term capital assets. This classification is essential because the short-term and long-term capital gains differs each other in relation to the method of computation, tax rate, and set off and carry forward of etc. What is short-term capital? Short-term capital assets are those assets which are held by an assessee for not more than 36 months immediately before the date of transfer. However, in the case of financial assets like listed shares, debentures and securities, if it is held for not more than 12 months immediately before the date of transfer, it is also considered as a short-term capital asset. In case of land or building are both held for not more than 24 months immediately before the date of transfer, falls under short-term capital assets. If it is movable assets, the holding period not more than 36 months, it is termed as short-term capital assets. It is a financial assets like listed shares, debentures, holding period is less than 12 months, it is considered as short-term capital assets. For immovable property, land and building, holding period is less than 24 months, it is considered as short-term capital assets. Next we will see the meaning of long-term capital assets. Those capital assets which are held by an assessee for more than 36 months before the date of transfer are long-term capital assets. In case of financial assets, if it is held for more than 12 months before the date of transfer, they are treated as long-term capital assets. In the case of land or building are both held for more than 24 months before the date of transfer, falls under long-term capital assets. Next we will see the meaning of capital gains. Capital gains means any gains arising from transfer of capital assets. What are short-term capital? Capital gains can be classified into two types. First one is short-term capital gain. Second one is long-term capital gain. What is short-term capital? Any gain or loss arising from the transfer of short-term capital asset is called short-term capital gain or loss. If there is any short-term capital loss, it may be adjusted from short-term capital gain or long-term capital gain. What is short-term capital gain? Any gain or profit arising from sale or transfer of a short-term capital assets. Short-term capital loss can be adjusted or set off with short-term capital gain or long-term capital gain. Next we will see the meaning of capital gain. Any gain or loss arising from the transfer of long-term capital asset is called long-term capital gains or loss. If there is any long-term capital loss, it may be adjusted from long-term capital gains only. It may not be adjusted with the short-term capital gains. Next we will see the assets not included under capital assets. Generally, capital assets include land, building, plant, machinery, investment, goodwill, manufacturing license, etc. However, the following are some of the exemption to capital assets. What are they? First one is stock in trade. Second one, movable assets of personal use like car, fridge, laptop. Next, personal effects like drawings, paintings, agricultural land situated within local limits, 6.5% gold bonds, special bearer bonds, gold deposits bonds. Next we will see the important terminologies under capital gain. First we will see the meaning of transfer of capital assets. Transfer includes sale, exchange, relinquishment of any asset, the extinguishment of any right thereon, compulsory acquisition under any law, where the assessee converts his capital asset into stock in trade to hand over the possession of an immovable property in the part of performance of contract for the transfer of the property, maturity or redemption of zero coupon bonds, and conversion of business into limited company. Example of relinquishment of asset. Suppose a co-owner of a property having definite share gives away his right in the property in favor of others. It is called relinquishment of asset. Example of extinguishment of any right. Suppose a promissory note is issued and the payment again it is not asked for 4 years. Then after 4 years the right of taking money does not exist anymore. Next we will see the meaning of full value consideration. Full value consideration, it is the consideration that is received in exchange for a capital asset by a seller. Full value consideration is nothing but it is a sales value of the capital assets. Full value of the consideration is, in simple terms, the money that you receive when you transfer your capital asset. In technical terms, full value consideration is the consideration which the seller has received or would receive in exchange for transferring his capital assets. Besides full value consideration, there are two other important terms: cost of acquisition and cost of improvement. What is cost of acquisition? Cost of acquisition means cost of acquiring the assets. It simply means the cost of purchase acquiring of a capital asset plus all expenses incurred to acquire it. Cost of acquisition is nothing but the purchasing value of the assets plus any expenses incurred to it. The purchase cost is the value of an asset when it is purchased by the seller. Example, suppose one machine is purchased for rupees 2 lakhs and the expenses on purchases like carriage, installation, labor for installation are rupees 40,000. Then the cost of acquisition in this case would be 2 lakhs plus 40,000. Totally 2,40,000. Cost of the machine plus all other expenses included in the cost. So cost of acquisition 2,40,000 for this machinery. Next we will see the cost of improvement. Cost of enhancement is the amount of cost incurred by a seller to make certain enhancements or improvements to a capital asset. Cost of improvement is the money spent on the capital asset to improve it. However, if the cost of improvement is incurred before 1st April, it would not be added to the cost of acquisition. Cost of improvement means an additional expenditure incurred to increase the value of asset. It includes all capital expenditure. For those assets acquired before 1st April 2001, amount incurred for improvement, that date should not be considered for computing its cost of acquisition. Next we will see the indexation of the cost. What is indexation of cost? Indexation of cost of acquisition refers to the cost of acquisition adjusted according to price level of the year of sale. If the assessee acquired an asset before 1st April 2001, then indexation benefit shall be available from the year 2001 to only, 2001-2002 only. What is the formula for index cost of acquisition? Index cost of acquisition is equal to index of the year of transfer divided by index of the year of acquisition.